Welcome, everyone. My name is Brendan McCarty. I am CIO and founder of Column E. Today, we're going to share the latest update on the CE funds and strategies through the end of July. The formal report came out over the past weekend, so this video is a bit late, but we'll catch up as quickly as we can and give you a few quick updates for the month of August as well. Just as a reminder, if you want to learn more about Column E, please visit us at columne.com. Catch us on our blog at Between the Columns and across social media platforms, LinkedIn, Twitter, and Facebook. Today, I'm going to focus on the three main strategies, including our new 3LW, and we'll give you a quick update, quick rundown of the node in general. So let's proceed. So we start today with what type of outlook we look for going forward. The major themes are the slower move, the low move in liquidity is still range bound for the most part. Combined with overly tight rate markets. So when the Fed tighten rates, the market has not adjusted yet to show easy conditions, which has been the case for the past year. Back in February, it did not adjust then, and the banks had major problems. This time around, it still has adjusted, and the banks are having issues again, as we discussed recently in our rundown note. How long can this persist, and can the S&P avoid a steep fall? Also, Treasury issuance is about to rise significantly. What will this have an effect in terms of rates? Too much supply, as we've always seen, leads to not enough demand. Liquidity has worked the other way, too much supply and there wasn't enough demand. Demand pushed every asset up across the globe. There wasn't enough assets, so to speak, to cover all the liquidity. We end with the VIX and how this will affect the VIX going forward. If liquidity rates are moving in different directions, and how will this affect the volatility of the markets, which theoretically could see the S&P drop significantly. With that said, this is still a lot of what ifs, and there's a lot of things that can go in different ways. So for the latest updates, check our rundown and check our latest blog for those. In terms of the strategies themselves, the moderation in the commodity pools continues. Trading the S&P is an extremely difficult endeavor. Coming into the pandemic, it was more introduction. It was just an easier two-wave trade. Now it is all momentum all the time. And given the pools don't chase momentum and perform very solid risk management, they've been lagging behind. So they avoided the roller coaster potholes of last year and have lagged behind this year. The 3LW, which is a combination of our popular 3L100 strategy from the Love It, Like It, Leave It on Monday mornings, has performed very well this year. It is a combination of 3L100 and our short-term trading model, the S&P, along with the 3L market. These three together have accomplished a couple of things. First, they're more diversified than the commodity pools, which just focus on the S&P. Second, they have more of a they deal with momentum more. They follow the equity markets from a momentum standpoint, while we use the S&P futures and the 3L market to balance that, to create a all-weather, if you will, or a more balanced picture in the markets. 3LW has had a very strong year. July was another strong month for it. As you can see from the returns, it's up rather substantially from 1 year ago. 3 months, it's performed quite well against the S&P, its benchmark. The month of August has added to those returns, and through yesterday, 3LW is actually higher than NASDAQ now in a risk-adjusted manner. As you can see, the upside, beta, downside models are favorable for all three strategies relative to the market. The Sharpe ratios have been strong for the LW and for the pools, as we'll show in later charts. Sortinos are good as well. Through the end of July, as I said, the 3L caught the S&P, but not the NAS. As I also mentioned, it went by the NASDAQ a couple weeks ago, like a week ago. The Harbinger LR was flat in July. Only a few trades offset. We had income coming in. The EN continues to chip away, more income focused as a result, leading to a better return for the year than the Harbinger LR. The EN is our traditional, more hedge fund strategy. though it too has lagged like many hedge funds this year against the S&P. 3LW again has performed well, as you can see on the chart to the left, relative to the S&P. The big volatility, the big numbers, the big uncertainty, if you will, comes through April into the summer, and now we're sort of coming into a period where the 3LW flatlines to some extent, though I don't expect that to happen given the uncertainties. As you can see, the Sharpe ratios have done are strong for the strategies over the 5-year span. 3 and not 1 for the pools are not the best, but they're still positive as we avoid the potholes. The picture to the lower left is Harbinger enhanced over time. As you can see, it just hits singles, and it continues to hit singles. Avoid those big drops in between. Hopefully gain more so on the upside, though that has been a challenge given the one view of the S&P 500. Beta is our most popular, is my favorite statistic. We tend to do very well when markets fall, and we tend to try to stay with the game, if you will, when they rise. The 3LW has a bigger equity correlation, thus lower beta numbers, so it will move up and down with the equity market to some extent. The pools themselves are hedging against risk moves, negative ones, and trying to gain positive trades. So now let's get a quick chart that's in focus this week. This is our stock selection volatility chart. Essentially, it measures what the volatility of stock is after we put it into the strategy. Since we pick these stocks based on earnings, you can see how earnings affect their performance. Into May, we hit a real high volatility peak. Incidentally, that volatility peak did not hurt the equity markets as much because liquidity shot up to offset that. Liquidity has tracked off lately. Interestingly, volatility has fallen. But since the beginning of July, volatility has begun to rise within the equity earnings returns. Last week or the week before, we had 4 shorts out there across some tech names that all missed, and that volatility measures continue to climb. Obviously the strategy benefited well because they were short. 2 factors that we're watching going forward: liquidity, as we've constantly hammered on. It's flatline. It's in a range, as you can see. It's at the upper part of the range from October to March. It was drifting lower, it drifted lower to start the month of August and has bounced back a bit. So it's not really moving lower, it's just flatlining. The second piece is long rates. The chart in the lower left is a quarterly long-term chart. We talked about this on the blog. We believe in 40-year cycles, or we see a 40-year cycle. We may not necessarily believe it, but the long bond has broken above this range. What does this argue? That we're seeing rates higher for longer, and it's not the Fed anymore we're talking about. We're talking about the long end of the curve. This argues that the markets are adjusting to a higher level of inflation going forward. And the first factor, liquidity, is part of the problem. So will the Fed adjust like Volcker did and reduce liquidity, or ignore it and try to use freights to offset it? 2 other variables: the trending gap earnings. We talked about this on Monday in the rundown. Essentially, gap earnings broke out on the chart. They have since moved lower, and you can see momentum. It's a top left chart. You can see momentum is moving lower for gap earnings. This argues that if gap earnings reverse, the results have not been good in the past. Now, if the earnings start to rise for the S&P, that will hasten the fall of the S&P itself. If earnings start to fall, well, the S&P is going to have to catch up or sell off quicker than the PE rising. Something to keep in mind. For the bulls, though, here, market breadth broke out at the end of July, and we did see equity buying at 2 or 3 year highs. This breadth model is moderating since, but still remains higher. So the bulls do have breadth on their side, which argues that August may be nothing more than a blip in the grand scheme of the bull market. As we wrote about earlier in our equity chart views, volatility argues that we never left the bear market. So it's an interesting discussion or thought process. Are these markets just very extended within a bear? Honestly, we don't care if it's a bear or bull necessarily. Our growth model right now is pointed higher. That dictates trading underweights and overweights, as well as direction. So we'll continue to favor such a stance going forward. After we finish up quickly here with the three strategies, Harbinger LR is a commodity pool regulated by the NFA and CFTC. Harbinger Yen is a strategy based on the Harbinger LR. We call it the mini me, if you will, if you're an Austin Powers fan. It's singles and doubles, more singles than anything. Finally, we finish with the 3LW, which has been, we're not showing the returns for 2020 yet, but we have those now. The 3LW has performed well over the past 4 years, largely driven by momentum. However, the DT and the 3L market did fill in gaps, and there is a strange ebb and flow to the returns as well, whereas you have up, down. This month, 2023 is actually over the 50% level as of yesterday. That return is better than 2021, and is kind of changing the ebb and flow, if you will, to this. We're not sure how long this lasts or it retrenches a bit, but the 3LW has continued to do well. Oh, apologies. Got to show you the disclaimer. So with that said, I thank you for joining us. Please read this important disclaimer in terms of the funds and the strategy and what you just heard. Thank you very much for joining us. My name is Brendan McCarty. Again, please visit us at columnme.com across social media channels, and I wish you the best happy trading for the rest of the month of August.